Good afternoon, guys. Today I'm going to share a short video with you about principal and interest loans versus interest-only loans. Now, I haven't really touched on this in some of the other videos, offsets, redraws and different things, but even though I'm a licensed real estate agent and a big part of what we do is to actually go out and find properties for our clients, it's not just about getting the right property in the right location. It's very much about the financial structure that you put behind the property as well that can make a massive difference. So I want to have a talk to you about principal and interest-only loans, and I'm going to talk to you about the differences and what's happened over pretty much the last 5 to 10 years and where the changes have been. So I'm going to start with the prior to the changes that APRA put in place, probably about 5 or 6 years ago. So back then, I would have recommended every day of the week that my clients go for an interest-only loan. And what we would do is, let's just say, here's our house here with our interest-only loan. We would set up an offset account next to it so that we could be pouring money into that offset, therefore reducing the interest on our loan. So let's just say we had an interest rate of 4% and our repayment at 4% was $2,500 a month, and that's P&I. So if it's a P&I amount, then that means that the interest component is only about, say, $2,000 a month, and the principal is $500 a month. So instead of putting the full $2,500 into a principal and interest loan, I would always recommend going interest only. This $2,000 here would go here to pay the interest only component of the loan amount. So your loan doesn't change in value because you're paying interest only. It doesn't reduce at all. And then what we do is we'd get the $500, which was our old principal amount, and we'd put that into our offset account as cash. And what that effectively does is means that as we build this cash level up in this offset account, we're actually reducing the interest payable on our home loan. So it has the exact same effect as a principal and interest loan doing it this way. The only added massive advantage that we have is a tax advantage, that the cash sitting in here can now be used for commercial means, meaning cars or whatever, and it won't ever affect the tax deductibility of the loan that is the purpose for this house. So prior to APRA's changes 5 years ago, absolutely every single loan I would look at, other than a disciplinary problem with my client, I would recommend interest only, and we would then put any excess money that we had into an offset account. Unfortunately, times changed, and as we saw probably 5 or 6 years ago, APRA stood in and they were very concerned with the amount of interest-only loans out on the market. So what they decided to do was define the difference there and try and discourage people from going interest-only, because even though my clients, who I'd consider in the far smarter echelon of society, and I don't mean to be nasty, were putting money into an offset. But I think there was a level of people out there that were interest-only loans that weren't putting any savings away. So APRA had concerns about that the loans were never getting paid down. So what they did, and this is now jumping across here to the post-APRA decision, they decided that what they'd do is they'd put a premium on interest-only loans. So what that means is, if we look at this example, if we've got a P&I loan, we might only pay 4% interest rate, but if we decide to go interest only, we're going to pay 4.8%. So what that really meant is that now I've got to really look closely at whether a client should go interest only or not, or whether they should go P&I. Now, it really does depend on the loan amount, the deposit amount, and a lot of other factors, their salary, etc. But in most cases now, we're actually recommending the P&I loan because of the lower interest rate. So what then happens is, if we go for a P&I loan at 4%, our $2,500 is $2,000 of interest and $500 of repayment going into that loan. But if we now go for an interest-only loan and we have to pay 4.8%, we might be paying $2,500 a month in purely interest. So you look at that and you think, well, hang on, why would I pay $2,500 a month in just interest when I can come over here and pay $2,500 and $500 is coming off my house? So it makes sense that we'd go for this P&I option absolutely every day of the week, and we would not go interest only. So the times have changed. Unfortunately, it doesn't, it was so much more flexible back here when we could do that. Unfortunately, things have changed a little bit. These split in interest rates is different in every bank. So, and I've used roughly a 0.8% change there. Some banks it's nowhere near that much. So it's very much a case-by-case basis. And what I do in my discovery sessions is I sit down with each client and we'll have a look at these sort of scenarios, and we'll have a look at whether they are better off on a P&I or interest only scenario, basically around their lifestyle and what they're doing. So at the end of the day, we want to minimize the cost to the client. We want to maximize their return, and financial structure is certainly a key part of that. So once we get that right and we get all that set, then we look at, what sort of asset we can buy, where we buy, and what's going to get us the capital growth. So thanks for joining in. If you've got any questions at all, please post them, let me know, fire away. Also, if you do want to book in a discovery session, please maybe just type in there, discovery session. I can get in touch with you, and we can arrange to do a one-on-one session and have a closer look at what you're trying to achieve. All the best, good luck in investing, and until next time, keep safe, and we'll see you soon. Thanks, bye.